You've seen the videos. We all have. You open TikTok or YouTube, and some 22-year-old influencer is standing in front of a freshly painted suburban house. He tells you he bought it for $250,000, put 20% down, rented it out to an amazing family, and is magically making $500 a month in pure passive income on day one. He flashes a neatly color-coded spreadsheet, smiles with his perfectly white teeth, and tells you that if you just buy his $997 course, you can quit your 9-to-5 job in 6 months. But if you scroll down and actually read the comments, real-world real estate investors are laughing. Why? Because the math you see on the internet is completely, utterly sanitized. It is a spreadsheet fantasy built for views, not for building actual wealth. These gurus forget to calculate closing costs. They use low primary residence interest rates for investment loans. They conveniently ignore the fact that local governments reassess property taxes the second you buy a house. And they assume the tenant is some mythical, flawless creature who never loses their job, never gets a secret dog that ruins the carpets, never flushes wipes down the toilet, and always pays rent exactly on the first of the month. Today we are going to do something no one else on this platform is willing to do. We are going to run the brutal, ugly, real-world math. We are going to put real estate head-to-head against index funds over a 20-year timeline. No skipped expenses, no fake numbers, no highlight reels. And I'm going to introduce you to a metric that I personally use, called the return on sanity. Because keeping your money is great, but keeping your hair, your free time, and your marriage is even better. If you are trying to figure out where to invest your hard-earned savings, do not spend a single dollar and do not sign a single document until you see the final numbers at the end of this video. The gap between the two will make your stomach drop. Let's meet our two guys, Alex and Ben. They are both 30 years old, they live in a mid-sized US city, they both earn $65,000 a year at their day jobs, and they both just saved up a serious chunk of cash, $70,000. They are at the exact same starting line, and they are ready to invest. Alex goes the real estate route. He wants that tangible asset. But he doesn't just walk into a store and buy a house. He spends his weekends grinding. He sacrifices 6 months of his Saturdays touring properties, dealing with flaky real estate agents, losing bidding wars to all-cash buyers, and stressing over inspections. Finally, he finds a decent 3-bedroom house for $300,000. The internet tells him to put 20% down, which is $60,000. Simple, right? Wrong. Welcome to the real world. To actually close on that loan, Alex has to pay $6,000 in closing costs, loan origination fees, appraisal fees, and title insurance. The bank doesn't hand you the keys for free, and because he's buying a rental property, it's not in perfect condition. It needs a deep clean, fresh paint, and minor plumbing fixes just to make it legally habitable and attractive to decent tenants. That's another $4,000 out of his pocket. His true, real-world cost to enter the game is exactly $70,000. His bank account is completely drained. He is effectively starting from zero in cash. Now let's talk about his mortgage. Gurus love to use a 5% or 6% interest rate to make their cash flow math look amazing. But investment property loans are strictly considered higher risk by banks. They add a premium to your rate. Alex actually gets a 7.5% rate. On a $240,000 loan, his principal and interest payment is $1,678 a month. But we aren't done. Add $300 a month for property taxes, which just went up because the city reassessed the home's value after the sale. Add another $150 a month for a specialized landlord insurance policy because standard homeowners insurance won't cover a rental. Alex's true monthly break-even, his PIT, principal, interest, taxes, insurance, is $2,128. Every single month, rain or shine, that check has to clear. He works hard, screens dozens of applicants, and rents it out for $2,300. This is a very realistic, even generous rent-to-price ratio for a modern suburban market. On the spreadsheet, Alex is making $172 a month in cash flow. Not $500, just $172. But hey, he's a landlord now. He has a physical asset. He has the keys. He feels like he's building a real estate empire. Now let's look at Ben. Ben also has $70,000, but Ben takes a completely different path. Ben opens a brokerage account on his phone. He buys a broad, total stock market index fund like VTI or an S and P500 fund like VOO. He drops the entire $70,000 in. It takes him exactly 4 minutes. He didn't give up 6 months of his weekends. No realtors, no inspections, no paint rollers, no closing costs. Furthermore, Ben makes a commitment. Because he doesn't have a tenant paying down a mortgage for him, he has to force his own wealth creation. He sets up an automatic transfer. He invests $300 from his own paycheck into that index fund every single month. He sets it, and he completely forgets it. The next week, Ben goes to the office. Alex is loudly telling everyone in the break room about his new property, his interest rate, and how he controls a $300,000 asset. He is the center of attention. People ask him questions. He is the local real estate guy now. Ben just takes a sip of his coffee and says, "Yeah, I just bought some index funds." People politely nod and immediately walk away. Nobody is impressed by an index fund. There is zero social proof. On day one, Alex feels like a millionaire taking control of his destiny, and Ben feels like a boring office worker with a PDF receipt from Vanguard. But feelings don't compound. Math does. Let's look at the first 5 years. The hidden bleeding. For the first year, Alex feels like a genius. The rent checks actually clear on the first of the month. He drives past his property on his way to work and thinks, "I own a piece of the earth." Then year 2 hits. And reality knocks on the door, literally. The tenant texts him at 9 p.m. on a Tuesday. The water heater is dead and there's water leaking onto the hallway floor. Remember that $172 a month in quote _1__? Over the whole year, Alex meticulously saved up about $2,000 from it. An emergency, after-hours plumber, and a new water heater installation costs $1,800. In one single afternoon, his entire year of profit is completely vaporized. He has essentially taken on a stressful second job to work for absolutely free. Year 4 arrives. The tenant gets a new job in another state and moves out. The house sits empty for 6 weeks. The bank doesn't care that the house is empty. They don't pause the mortgage. They still want their $2,128 every month. Alex pays over $3,000 completely out of pocket just to cover the mortgage and utilities. But it doesn't stop there. Turnover costs are brutal. He has to professionally clean the carpets, paint the scuffed walls, fix the broken blinds the tenant left behind, and pay listing fees to find a new renter. That's another $1,500. By year 5, Alex realizes that quote 2 is largely a marketing myth sold by course creators. After real-world expenses, vacancy, turnover, and maintenance, he is mathematically operating at a break-even, or sometimes a slight loss. What about Ben? During those same 5 years, Ben did absolutely nothing. The market had a bad year, then a flat year, then a great year. Compounding at a historical 9% average return, his initial $70,000, plus his $300 a month, has silently grown to roughly $130,000. He hasn't fixed a single pipe. He hasn't answered a single text message at 9 p.m. He hasn't lost a minute of sleep over a vacancy. But right when you think Ben has won the game, we enter the middle game. Years 5 through 10. And this is where the stock market tests your soul. Ben doesn't have to deal with broken toilets, but he has to deal with psychological warfare. Let's say year 7 brings a massive global recession. Think 2008 or the crash of March 2020. Ben logs into his app and watches his $130,000 portfolio plummet to $85,000 in a matter of 3 weeks. The news networks are screaming that the economy is collapsing. Financial YouTubers are posting thumbnails with red arrows pointing straight down. His coworkers are liquidating their 401ks in a panic, moving everything to cash. It is physically nauseating for Ben to look at his phone screen. This is the hidden cost of the stock market: extreme volatility. Real estate prices drop too, of course. But Alex doesn't have a ticker tape in his living room screaming the fluctuating price of his house every 5 seconds. Alex's tenant is still paying rent, so Alex just ignores the macro economy. Ben has to have nerves of steel. He has to do the hardest thing in the history of finance. He must ignore the panic, hold his shares, and keep his automatic $300 transfer running every month, buying shares at the absolute bottom of the crash while everyone else is running away. Meanwhile, Alex is grinding. And underneath the surface of his stressful landlord life, something magical is actually happening. It's the real reason real estate creates so much wealth. It's not cash flow. Cash flow is a distraction. The real wealth is built through loan pay down and market appreciation. By year 10, Alex's $300,000 house has appreciated by a conservative 4% a year. It's now worth about $440,000. But better yet, his tenants have spent 10 years paying his mortgage for him. His loan balance has dropped from $240,000 down to roughly $205,000. Value minus debt equals equity. Alex's net equity is now $235,000. He still hates getting phone calls on weekends. He complains about his property taxes going up, but mathematically, he is undeniably getting wealthier. Let's skip ahead. Year 20, the finish line. The numbers here will completely shift your perspective. Let's look at Alex first. After 20 years, assuming historical averages, his property is worth roughly $650,000. His mortgage is nearly paid off. He only owes about $110,000 to the bank. His total equity is a staggering $540,000. But wait, we promised real-world math. We have to subtract the capital expenditures that the internet ignores. A house is a decaying box of wood and pipes. Over 20 years, Alex had to replace the roof for $12,000. He replaced the HVAC system twice for $15,000 total. He bought new water heaters, new appliances, and replaced the flooring between tenants. He dealt with maybe 5 or 6 months of total vacancy over 2 decades. After adding all his maintenance, taxes, and capital costs, his net profit from whatever tiny cash flow he had is basically a wash. It all went back into the house just to keep it standing. His true, realized wealth is right around that $540,000 mark. Now let's look at Ben. The boring, uncool index fund investor. Ben's original $70,000, plus his disciplined $300 a month, compounding at a 9% historical average over 20 years. Ben's portfolio is now worth roughly $590,000. Look at that. $540,000 for real estate, $590,000 for stocks. In terms of pure net worth, they are incredibly close. Both men succeeded, both men beat inflation, both men are wealthy. But how they got there, and the quality of their everyday lives, couldn't be more radically different. And this brings us to the ultimate metric, the return on sanity. Alex's wealth is trapped inside drywall, concrete, and copper wiring. It is highly illiquid. To access his $540,000, he either has to sell the house, paying around $39,000 in realtor commissions and closing costs and getting hit with massive capital gains taxes, Or he has to go to a bank, beg an underwriter for permission, and take out a home equity loan, voluntarily taking on more debt just to access his own money. Ben's wealth is entirely liquid. If he needs $50,000 tomorrow to pay for his kid's college tuition or a medical emergency or to start a business, he clicks 2 buttons on his smartphone and the cash is sitting in his checking account by Wednesday. Alex spent 20 years operating a small business. He spent hundreds of hours managing tenants, coordinating shady contractors, fighting with the city over permits, and worrying about liability if someone tripped on his sidewalk. Ben spent exactly 0 hours managing his money. He spent those hundreds of hours advancing his career, getting promotions, traveling, and being completely present with his family on the weekends. Now, if I stop the video right here, the real estate guys in the comments will riot. And honestly, they should. I want to be perfectly fair to the landlord side of the equation. Cheat code. Number 1. Leverage. Alex used $70,000 to control a $300,000 asset. When that house went up by 4%, the total value went up by $12,000 in a single year. That's a 17% return on his actual cash invested. The bank took 80% of the risk by lending him the money. But Alex kept 100% of the profit. You cannot easily go to a bank and ask for a $240,000 loan to buy index funds. The government subsidizes real estate leverage. Cheat code number 2. Tax shenanigans. Through a beautiful legal mechanism called depreciation, the IRS allows Alex to pretend that his house is physically deteriorating over 27.5 years. This means he can write off the value of the structure against his rental income. He can legally shield almost all of his rental cash flow from the IRS. Ben, on the other hand, pays taxes on his stock dividends every single year, guaranteed. Cheat code. Number 3. The 1031 exchange. If Alex decides to sell his house for a massive profit, he can use a 1031 exchange to roll that money into a bigger property, like a fourplex or an apartment building, and legally defer 100% of the taxes. He can keep trading up until he dies, passing the portfolio to his kids tax-free. If Ben sells his stocks to buy something else, the IRS takes 15% to 20% in capital gains immediately. So after 20 years, what is the final verdict? Which one actually makes you more money? It depends entirely on what you want to be, an operator or an architect. If you are willing to treat real estate as a literal high-friction business, if you have the stomach for it, if you learn how to actively manage properties, ruthlessly leverage debt, and exploit the tax code, real estate will likely make you richer, faster. It is an environment that disproportionately rewards people who are willing to do the dirty, stressful work. But if you value your time above all else, if you want your money to work for you instead of you working a second job for your money, if you want absolute liquidity, total geographic freedom, and zero customer service, the stock market is the greatest wealth-building machine in human history. The biggest trap in the modern financial world is buying a rental property because a TikToker told you it was passive income, only to wake up 3 years later and realize you accidentally bought a stressful, illiquid, highly taxed second job. Look at the reality of your time. Look at your stress tolerance. Choose your hard. And whatever you do, stop trusting the sanitized spreadsheet math of guys trying to sell you a weekend course. If this video saved you from making a massive financial mistake, hit the like button. And if you want to know the exact boring index funds that Ben used to build his portfolio while he slept, click the video on the screen right now. I'll see you over there.